Today, we're happy to welcome Aaryaman Patnaik on the podcast. Aary is currently studying a Masters of Finance at the University of Warwick and is the managing partner of A&A Investments. Rather than going straight into a Bulge bracket investment bank graduate position after his undergraduate, Aary co-founded A&A Investment Group, a multi-strategy investment fund that specialised in active management of investment portfolios. Today, he talks about his journey in finance, thoughts about Indian equities and emerging markets, challenges starting his own fund, and advice for others interested. If you enjoy, please like, subscribe, and share so we can continue to have awesome guests like Aary on the podcast. Thank you. Aary, thank you so much for joining us today. I really appreciate it. So my first question is, how did you get into finance? Like, was there a specific moment you wanted to pursue the career or?
Yeah, thank you for having me, first of all. So my interest in finance really, stems from my interest in economics, which I had at first. So for me, for those who don't know me, I'm originally from India, but I've, lived and grown up my whole life in Germany. So for me, going on holidays very often, even during high school, I'd be sitting in the car and, just outside would be, 5 or 6 kids my age, with no clothes on. You could tell that they were sick, probably hadn't eaten for a while. And to me, it always just seemed, why is it like this? Like someone who lives such a normal life in Europe, why is it so different to, essentially the same thing? Even access to doctors. If I want to go to a doctor here or the UK, you just call and go. But in India, you have to, pay in advance. You often have to save. So for me, this sort of disparity was always very interesting. And then, studied economics at university, as you do. And then, at some point in my first year, I had that one class on finance where it was like, yeah, here you'll learn, you'll not learn how to get rich, but you'll be given the tools to get rich. And obviously, as an 18-year-old just studying economics, you're fascinated by the idea, and you think you'll become the next Wolf of Wall Street and whatever. But I think that's very far from reality. I think a lot of people, not saying investing is very difficult, but a lot of people go all in, get scared by the idea because they lose a couple of bucks, and then are out of it. And then for me, I think the biggest factor that sort of pushed me into investing is once I started building my own interest. My grandfather, who was an avid investor in Indian markets, told me, yeah, I've been investing for a while. Why don't you see what it is, what I do, how I do my research, which is, way more traditional than what you do now, so things like technical analysis, where he doesn't do any of that. And maybe we can discuss about later how, investing principles around the world differ. But I think it was really that moment where I sort of, saw my first company analysis, where I was thinking, okay, most people think of Apple and they're like, okay, they make iPhones and whatever, but Apple does so much more than that. You actually have to look into their numbers to see why and truly understand the business. Because when you're investing, you're not investing really to, or at least you shouldn't be investing just to make a quick buck. It should be investing because you believe in the company and want a part of it. Because end of the day, the part of the company that you own is what will get you money. So just having this understanding and sort of knowledge of how companies operate and understanding the business behind it really sort of pushed me to it. And then I think it was around my 19th birthday, I went to my parents and I said, Mom, Dad, can I have, 2,000 euros? I'll try and invest it and make you money. I can't guarantee anything. But as I think most parents are willing to give their kids some money to gamble with, and luckily or fortunately for me, it took a while. I think must have taken at least 1.5 years until I doubled that money, because I was very scared. I'd buy maybe 2 stocks a year. So it took a while, but all through that time I was learning. It wasn't that I bought 2 stocks and then just went to live my normal teenage life. I was always reading and watching other investors, and I think investing is a business you need to learn from others. So I think that was probably the where I sparked that interest, and ever since then it's just been amassing this knowledge just to keep improving.
Yeah, awesome, man. It's super interesting. So it's something that you said before, that your grandfather had quite a big different analysis process compared to yourself, and I guess the younger generation. And I think we were talking about it before, like it's the same with some big institutions, a lot of the more boutique places. Do you want to maybe talk a bit more about that and explain sort of your thoughts on that and why that happens?
Yeah, sure. So I think what's interesting around the world is each country's market is driven by something else, and I can comment on the Indian market. I think the Indian market is driven a lot by sort of pride and sort of about your own country, and also a lot by emotion. And there's this famous example, where, and let me, maybe I'll start by saying in India, 10, 15 years ago, if you said you want to invest in something, you either invested in gold or property, because anything else was too risky and was a scam, as my mother till this day thinks the stock market is a scam. Because, you read that one big trader who lost all his money and then you think the whole thing is rigged. So So from that point onwards in India, stock market was for the very few who could afford, losing that money. And as with most emerging economies, the disparity between the rich and poor was so much that, until probably the last 5 years, the stock market was very limited to those who could afford it. And in India, it wasn't that you could, there was no Robin Hood. You had to, deposit maybe, $1 million in the account to invest, which in India, percentage wise, not a lot of people have. But my grandfather, he started buying, started out by buying household names. So like in the UK, that would be, your big companies equivalently. So he did that for India, bought like the 5 biggest companies. And he bought these in maybe 2000 and 2000, probably late 1990s, early 2000s, and just held them. That was it. He told me, I don't look at the stock price every day, because if I see a 3% drop in one day, I'll get scared and sell it. And then 2 weeks later, it might be up 20%. And I think that's the first rule of investing, which differs investors from traders. If you speak to any modern day investor in the classic sense, they don't, if you ask them what's your stop loss, they'll just look at you and think, why do you need a stop loss? You're investing in the company, not in the price action. And so that buy and hold strategy till this day. So he sadly passed away a couple of years ago, but he, whatever stocks he had, I inherited them, and those are all up now like 800-900%. So it goes to show that, yes, you can try and time the market and, only get it at a profitable time. But if you really want to make money both off dividends and capital gains, you need to hold it. The example I was referring to, and, this is commonly quoted, no one really knows if it's true or not, but it was a pharma company in India got a takeover bid from, one of the big American companies or whatever. And where do you build a factory? So you can't build in the big cities, so you have to go to the rural parts of India. But rural villagers in India, their farmland is the only thing that matters to them. So any investor in India knows this, and they knew that the farmers won't sell their land for whatever price, because that's their entire pride. But foreign investors obviously overlook this. They see a prime opportunity. India even now in the COVID times is producing the most vaccines in the world. And finally, these farmers didn't allow the sale, so the deal fell through. And a lot of international investors that didn't have this regional knowledge lost a lot of money. And I think that just goes to show how important regional expertise is. I know for most developed markets nowadays, and with the internet, it doesn't really matter. But I think especially in emerging economies, having that inside edge is very valuable. And that's not something you can just get by writing a code or spending more on technology. That's something you amass by growing up. So even now, I invest a lot in India, and I'll ask my parents, like, what do you think of this company? Because the fundamentals might be great, the technical aspects might be great, and I wanted to invest in, this is like a basic example, I wanted to invest in an air conditioning company, Indian-made air conditioning company. Everything looked great, and then my dad said, yeah, that's all fine and all, but India is growing. They don't want to buy domestic air conditioners anymore. They want the international ones, so they're going to buy your Samsung, your LG. And that's just something I never thought about, because for me, I was just, okay, the company looks good, let's buy it. So I think having that insider knowledge really, gives domestic investors the upper edge.
Yeah, perfect. And would you say, because I know you're, as you said, you're quite interested in Asian, especially Indian stocks. Would you say that's quite common around a lot of the emerging markets as well?
I think so. I think when you look at emerging markets, and one thing that saddens me about emerging market, especially if you look at ETFs, ETFs are very popular these days. You go in the country breakdown, and almost all of them have at least 60 to 65% in China.
Yeah.
China is a great market to invest in, don't get me wrong, but there's so much in Asia you're sleeping on. I think China and India will become the 2 largest countries, economies by the end of the decade. Sorry. So I think when you're heavily weighting it so much on one country, and China is obviously not the most transparent. If you look at their Ant Group IPO, which any other country would have been happy to allow it, China blocked it. So when you have that sort of uncertainty surrounding what's going on in the markets, do you really want to have such a great country exposure? When it comes to Asia in general, and maybe if we just take a step back, if you look at China and India, I think they account for maybe 20% of the global population, I think.
Yeah.
Something like that. And especially, the middle class, which is the group that is participating in investing. I think they're going to grow by, say, I don't know, maybe 2 billion, maybe 1.5 billion by 2030. So you're going to see this huge consumption rise in both India and China. And I think that's what a lot of people are missing out on. I think Asia has this investment opportunity, which is just too big to ignore. But a lot of European investors I know are wary of it, because you have a lot of risk. You have your interest rate risk. You don't know what the government's up to. So anything could really happen, right? And I think what India makes specifically. So a lot of people say, yeah, there's no argument. China's economy will grow the largest. But I think in terms of growth rate, India will grow the fastest, especially because in the last 4 or 5 years, a lot of foreign investors have been pulling their money out. So I think right now asset valuations are at a very attractive price. I think India has just above 450 million people under the age of 20. And when these people start working and consuming and spending, you'll see the amount of purchasing from India, skyrocket. And I think if you position yourself as an investor now, and whether it's retail or financial institutions, India, I think for a country of its size, the financial inclusion is very, very low, especially in the villages, because your big banks don't cater to that area, or used to not cater to that area. Even though these people, if you think about it, I think 60% of India lives in rural villages. That's 60% of the country's wealth. I mean, if everyone had equal wealth, that you're missing out on and not serving. So I think once you start including this, and they become more prominent and become more connected, you'll be very well positioned to invest in. And I think overall, if you have a long-term investment horizon, I'm talking maybe 5 or 6 years, this rising income and consumption combination in China and India, as well as the rest of Asia, will put you in a really good place.
Yeah, awesome. Yeah, because I think I invested in a emerging markets ETF. It was the same as you said, 60% China. And I think you had Samsung, a few South Korean companies, and then like Taiwanese chip makers. And that was basically
and Hong Kong probably. Yeah,
exactly.
And I think it's always funny because you look at these ETF comparison websites, and you put your filters, and you put a China ETF and an emerging market, which an emerging market is that's not even accounting for South America, which I think is also a very interesting emerging market. But the two ETFs almost look identical.
Yeah.
Just that one has China in the name, the other one, says it's a diversified EM ETF, but it's really not. But yeah, I think if you were to pinpoint maybe 2 or 3 things, I think technological adaptation, Asia is miles ahead of Europe and the US. If you look at Japan, China, India, Taiwan, Indonesia, Singapore. I think their technology spend will easily surpass that of the West. I think especially, as you mentioned, semiconductor companies in China, Taiwan, and Korea will become market leaders. You have this whole 5G revolution coming, which I think a lot of people are still unaware of because, at least in Germany, we don't even get decent 3G. So 5G is, something of the future. And I think if you look at IT service, like professional IT services, I think India is becoming the hub of the world for that kind of thing, stuff. I think you'll see maybe a 6 to 8% increase in digital transformation over the next few years outside the US. So I think technology is probably the one big driver. I think what else you need to look at is, again, the middle class. Some people argue the middle class is disappearing. I just think it's not disappearing. It's more that you have to reclass it, right? I think this lower class, middle class, upper class is a bit old, because nowadays, $1 million these days is not that impressive anymore, right? I think there was an article by Bloomberg of how much money you need to be in the 1%, and in India it was something like $70,000, which in the UK is that you'd have much more 1%ers in the UK if that was the benchmark.
Yeah.
And I think if you look, maybe 10 years from now, I think at least 30 or at least 60% of the middle class will be from Asia, including Asia, including China and India, but also outside. And I think since the financial crisis, really, all these companies which had a very strong domestic focus are now taking over the rest of the world. If right from your technology companies to your consumer cyclicals to your automobiles. It's definitely on the rise, and they've dominated the Asian market so well. I don't see anything to stop them, because they beat most other producers on price, on efficiency, at speed of delivery. So I think there's a lot in the future for that to come.
Yeah, awesome. And why do you think there's been sort of you said that a lot of international sort of investors have gone out of India? Why do you think that's happened?
So I think it has a lot to do with the leadership. I know at first, there was this huge push to sort of attract foreign capital. India has the people. I think they're a lot more transparent than a lot of their other Asian peers. Skilled workforce. If you look, either in the UK or the US, most high skilled jobs are being done by Asians, especially in the tech field. I think the reason it happened was, these returns that maybe they got in their first 1 or 2 years started getting dampened because, the government shifted their focus to other things. There started coming this more push for, at least for India to make things domestically. So that's why foreign investors were losing out because, if all your whatever government contracts or domestic contracts are no longer going to the, Samsung and LG India, whatever, they're staying with domestic companies, you feel like, okay, we're losing out on this market, it's done. But I think especially now, and a lot of people might not agree with this, but I think this COVID situation has given a lot of foreign companies a reason to sort of shun China a bit. Not only because of their lack of transparency, but they find that in India can essentially do the same with the same amount of investment. You have a much more transparent view of what's going on. You can decide what's going on, and India itself, I think, is able to run much higher production capacities just because the people aren't restricted in what they do. I think China, what happens is you specialize in something so specific that if the business later on wants to produce something else or change, that doesn't happen. So I think India, that's why, has recently been seeing a lot of inflows again, because they've now opened themselves up a bit more, and are sort of not entirely ditched, but sort of are broadening their focus from only producing domestically to allowing foreign companies. And this even goes for the banking sector. I think a lot of banks, or a lot of people in India, were scared that foreign banks have too many shares of domestic banks. But I think now they've introduced a new mandate where I think on a board of 10 you can only have 3 foreign board members, even if their stake might be higher. So I think that sort of gives people some reassurance, because you could run the best bank in the US, but you might do a terrible job in India because the market is completely different. That again goes to this regional expertise. You need to know what works domestically. So I think those two reasons combined, in the last 5 years, pulled a lot of money out, but I think it's now coming back. And if you look at the inflows, it's been steadily increasing since probably last March, I guess.
Yeah, awesome. Yeah, well, I know sort of for Australia itself as well, they've had a lot of issues with China, and I think the US and Europe is just going to be the same, and the UK as well, it's going to be the same. So I think India, yeah, as you said, it's the best place. It's next best, isn't it, compared to China? And it hasn't really had it has had development, but not as much. So I think, as you said, there's definitely that potential for mass growth and to be just behind China in that regard as well, I think.
Definitely.
Yeah, awesome, man. And do you think there's an issue? Because I know has been, they call it sort of like brain drain. And I know India is well known for a lot of people going to sort of Australia, the UK, US, especially the really smart people. Do you think that could change if it does grow?
I really hope it does. And I was having this discussion with a family friend of ours. I think the one big problem is, and it's not just in India. I think most people want to, when they finish university, they want to work for your Google, Amazon, those big Fortune 500 companies that everyone knows, because hey, you get the job security, the benefits, whatever. And it's true. Even Amazon in India is not able to offer nearly as much as what you would get if you worked for Amazon in the US. I think what they're doing to stop that is, I think if you look at even your biggest companies in the US, they're now heavily investing in India to keep people there, because not only I think will you have access to a lot of talent gets locked out because people are afraid to go to the US. You have great students, and here's not scary fact, but what always astonishes me is like if you look at the top university in India, which has a cutoff of say 97%, right? I think if you're getting 97% in your mechanical engineering, you can do a great job anywhere. And if you ask these students, what are they most afraid of? It's not about getting a job after, because they know they will. It's their biggest fear is that if they don't go to this top university in India, they'll have to go to their backup. And then when you ask them what their backup is, they'll tell you something like MIT or Stanford, which for anyone else is great, but for them, 97% cutoff is the real benchmark. So they're applying to Harvard, they're getting in, but that's their backup choice, because they know that if they graduate from that university in India, they'll get a top job and won't have to move. And I think especially now with this whole rise in sort of nationalism a bit, the government is promoting a sort of stay here, help the local economy. I think a lot of people will stay here as well. Of course, end of the day, money speaks. If Facebook is offering you hundreds of thousands of dollars to go, nothing's going to keep you. But I really do hope so. I really do hope so. I think India would be in a much better position if you didn't have as many people migrating away. It's obviously great for them, and end of the day, you have to look out for your own interests and your families or whatever personal motivation you have. But I really hope so. I really hope in the future that it reduces, and you already see it reducing. A lot of people are coming back now, or want to stay domestically, because like I said, these foreign companies are enabling them to, earn maybe not necessarily the same, but decently while working from India.
Yeah, perfect. And I think it's a classic, like you go to the UK or US to get a master's maybe, and then your plan is to come back because you have that. I know my cousin from Greece actually, he moved to the UK to get a master's, and now he's back in Greece. And I think that's, I think once people do that, they are looking for, it's not as much about the money, it's about the quality of life, being close to family. And a lot of being in the middle center of London might not, in the smallest apartment working 20 hours might not be the best quality of life. I think people are noticing that now.
Yeah, definitely. I completely agree. And yeah, like I said, this happens at all levels. I think it's not just young college grads. I think even later on in life, you want, if you're going to do it for 40 years, you may as well enjoy doing it for 40 years.
Yeah, definitely. There's that massive, and I think we saw that with the Goldman Sachs interns planning about 90, 100-hour weeks. Just people aren't willing to put up with it anymore to grow. They all want to push the quality of life now.
It is, and I think that's why you see a lot of smart people are leaving finance to work in places where they can use their talents. And this is again probably a unpopular opinion, but as an investment banking analyst, in the first 2 years, you don't need a degree in finance to make PowerPoint slides. Let's be honest here. So that's why those people are then going and working, in private equity. And I think most people just join on investment banking to go somewhere else. I think the people that stay in investment banking their whole life are, you have to either be really, really passionate for it, or, like you're saying for the other thing, just be stuck in that environment that you can't imagine yourself in any other role. And that's why I think you see also, obviously the money plays a huge factor. And I think that's a large reason why people still stay in it. And especially in these days where you see people coming from all sorts of fields. I think it was one of my professors was saying that, we'd be years ahead in space exploration if all the astrophysicists weren't working for Goldman Sachs or JP Morgan, because, if you pay them the money, again, they'll leave. And I think that's it's a bittersweet thing. Of course, I understand the need for the talent there. But yeah, when you have so many options available, then, and this is probably, again, banks won't tell you this, but, if you as an analyst don't want to work 90 hours, they'll say, fine, leave. There's 100 people waiting downstairs who'll do your job. So.
Yeah, I think that's so true. It's just, there's so much demand for all that. And I think it's something we mentioned before as well, that, just in the investment banks, they don't really have that innovation compared to a lot of the, sort of the smaller boutique funds and, just the way they research. And I think you were saying that the top 10, funds or basically investment banks, they basically invest the same way, whereas a lot of the others have their own unique. So if you can sort of talk about that, and I know you were talking about the billionaires quote as well, which I found pretty interesting.
Yeah. I think for me, it's always interesting when I, go into some company and look at their top shareholders. You'll always see BlackRock and Vanguard. Either one will be first, the other will be second. And when you're essentially investing in the same thing, your research won't be that different, right? Because, there's no doubt that the companies are great. So I think that way you get into this sort of rhythm where, you're analyzing every company in the same way. You might have, if you have a, sectoral desk, then, if you're a technology analyst, you're analyzing Apple the exact same way as Samsung. Maybe you look at, slightly more regional factors, but essentially it's the same research, right? I think when you go to a smaller shop, when you're not specialized, one day you might go to your, investment committee and tell them, oh, I found this really cool, there was a company that makes these glass vials for vaccines, very interesting. But for a huge hedge fund, or for a huge asset manager, by the time they find that, all the smaller funds are already in it. By the time you get to it, it's already too late, because, your assignment is to look at mid caps in Asia that focus on something completely different. Whereas in a small fund, you can rock up every week with a different sector, different geography, different size, whatever. So I think that way, you're thinking out of the box is way more at smaller shops, because you're not given these guidelines. I think very often, I can't speak for sure, but I can well imagine that, on your first week of training, you get told, okay, we only invest in companies that meet these factors, because that's what our clients tell us to invest in. And just from then, you might go from 100 companies that suit that to 5, and then picking or having to forcefully pick one from those 5 because you have a deadline in a week, I think just, hinders your creativity. And I think even the worst trade, if you have the right amount of insight and creativity, can be turned into a good one, or can be presented as a good one if you believe in the opportunity. I think that just presents itself more in smaller places, which I think even if you look at startups, right? I'm not in a position to give life advice here, but I think if you go work for a startup, that's the most interesting place to be, because you're being part of the growth. Even if it fails, you learn amazing things from a startup. You learn all parts of the business, right? You learn how to do the accounting, you learn about the legal aspects, you learn about branding, about PR. Whereas if you go to a fully established business, you apply for one particular thing, and that's the only thing you'll ever know. So I think now is a great time to invest in startups. But that again goes, back to the thing that people are afraid, that they're afraid of, if they tell their neighbor, I work for so-and-so company, the neighbor is going to be, I've never even heard of that, you must be not successful. And then 5 years later, that thing might turn into the next Facebook. So I think that fear of, wanting to work at a place where your parents can tell their friends that you work there, has probably led to a lot of startups failing. Because again, it's this thing of, the smart people are definitely there. I just think they're too afraid to try things outside their comfort zone. So.
Yeah, I think it's that thing of linking back. People want it now as well. They want the nice job now. They want the fast car now. Same with investing. Sometimes why people lose lots of money. They want the results now, not in 5-10 years.
Exactly. And I think end of the day, it's the long game, right? I think anyone who's not investing for, it starts out, right? I first started investing for retirement when I was, I think 20, 20 retirement is 65. So people are like, why are you thinking about your retirement now? It's like, because I have my whole life to earn money. So I don't need the money when I'm 20, 30 or 40. My job will pay for that. I need the money when I don't get a job anymore. Who knows by then what the government, retirement scheme will look like. So I need to, I need to finance, or need to know how I'm financing myself when I'm not making, a monthly income. I have a lot of people that'll come up to me and say, Aary, I want to, buy a, $500 pair of shoes next month. What should I invest in? I'm like, first of all, nothing, nothing, reasonable and sustainable will get you that much money from your, your 10 pounds or whatever. You have to invest for the long run. And I think you shouldn't invest for those kind of goals. Like, sure, it's nice to have some passive income, and you can look into, ETFs that pay you, monthly dividends and whatever. But I think, most people will know that obviously the power of compounding, I think everyone's familiar with that. It's much, much better off planning for the long term, because if you plan that you'll only withdraw it in 60 years, even if 10 years later you want to take something, you'll have more money than if you take an ETF, for example, which pays you out money quarterly. So that's why I don't think you should plan for the short term. I think long-term planning is definitely the way to go. And that's what I would advise everyone as well. And yeah, I guess, at the end of the day, it's human nature. You want to know that, all the money you're putting into these stocks is paying out, right? And I think that's another mistake people do, which I used to make as well. I would, I think when I bought my first 3 stocks, I, had I had the broker's website open the whole day while I was at university, and I would always be checking it and literally looking at, on a minute chart. And that's the worst thing you can do, because there might be a sudden drop and it'll completely, distort your view of the stock, because you'll think, oh no, it's gone down, such a big bar, which, on a 4-hour chart might be nothing. So I think just, trying to separate yourself. And I think there's, again, this huge debate between a trader and an investor. But once you know what you are, you should stick to that and not deviate just to meet your short-term goals.
Yeah, perfect. And for yourself, would you say that you sort of have assets that you just invest in and assets that you trade as well? Is that sort of how you look at it, or?
I think so. I tried, I've tried and done both. It keeps going back and forth. Sometimes I think, oh, and I hold all my stocks for at least 3 months. I'm an investor. And then, next month I'll, buy something and sell it to, like 2 days later and say, oh, I'm a trader. Yeah. But I think that again goes to that discipline of what are you really investing in? A lot of people investors will invest in the company because they think it's a good company, but traders will invest in it because someone else thinks it's a great company, which is driving the price up, and you just want to be part of it. And I think that just differentiates you. And for me, it's really become this understanding of the company. Like any investment I do is not just looking at a chart. I will, by hand build the DCF model, look at the valuation of it. I will try to find out, okay, is it, trading at a slower range, higher range? And if I know, like if I have a range of a company and it says, low range is say, I don't know, 50 million, high range is 100 million, it's trading at 20 million, I will buy it. And then I won't look at it until it starts getting towards the 50, because it'll eventually get to that level. Whether it takes a week or if it takes, 5 years, doesn't really matter, because I know that it's underpriced. Whereas, traders will say, okay, it's currently trading at $20. I think it should be $25. But then they're disappointed when it starts going downwards. But even though the 25 price target is a 12-month price target, but they want it to happen now. So I think that's the greed of sort of, you want instant results, which just doesn't work. Nothing, even going to the gym, you don't get results overnight. It's just hours and hours of dedication. The only difference is here, you just have to invest in it, go to sleep, wake up 2 months later, and, you'll see the positive results. So I think what's also great is that a lot of, people that do set up these ETFs, and that's another piece of advice I give, they will only have their statement emailed to them once a year, because they don't want to know on a daily basis how their investments are doing. Because I think psychologically you need to really have that strength to be able to have worse months. I remember I was talking with friends, last March when the pandemic had just hit, and then they were saying, oh no, like Aary, I have too much stock exposure. What should I invest in? I was like, honestly, if I were you, I would buy more stocks. Like, are you crazy? They're crashing. I want to buy bonds. What bonds should I buy? I'm buying German government bonds. I'm like, German government bonds are paying you, minus 0.1%. But if that'll, psychologically, if that'll make you feel good, go for it. And then it got so my birthday's in April. So I invited some friends over for drinks. I was like, yeah, what's the problem? Like, I don't get what's happening. Like, the stock markets are going up, but like, why do I have so few stocks? And I was like, yeah, because when I told you to, buy more, if you look at any market crash, the stock has always recovered very fast at a much bigger magnitude. And I think it's just this fear where, I know this, whole buy the dip thing is often taken as a meme these days, but you should be. And I think that's what Warren Buffett says, right? You say, like, be greedy when others are fearful and be fearful when others are greedy. And that's the thing. And then they were all complaining, like, yeah, why didn't you, push us more to buy more stocks? And you should have been more, been more strict with us. And I was like, I can't force you to invest in something, because if it would have gone even further down, you would have also screamed at me. And I think that's just not my, I don't want to be in that position. So I think those are sort of the things you need to keep in mind. Have a strategy and think to it. Like, I have an investment rule. I never place a trade or open a investment on a Monday, because I think, whatever news and anticipation has been there over the weekend, it can't be priced in on the weekend. It happens on a Monday. And what you'll see is, market opens on a Monday, stock jumps up 10%. People will be like, oh, it's gone up 10% today. It'll go up by 15 tomorrow. Let me buy it. And then it opens on Tuesday. It'll go up 2 more percent. And then everyone who bought it on Friday will sell their position and the stock will tank. And I think if that just keeps happening, it's again the psychological thing. You shouldn't, have this fear of wanting to miss out. And I think that's a big lesson. Like, don't let your emotions get the worst of you, or best of you. I'm not sure what way around it is, but yeah.
Yeah, I had that experience this week actually. I was longed Australian dollar, Japanese yen. Went up, I was doing really well, and then it literally crashed about 300 points. And I was just like, and it's bounced back now. So I held it like stupid. I should have had a stop loss. I didn't, but I held it. And it's bounced back now. But it's literally what you said. It literally will crash down. And then Thursday, you just sort of see a bit of a recovery for Friday, which is what you normally see. Yeah.
You will, so, and then you'll hate yourself for having set the stop loss, because if you would have waited, your position would have been green. So
yeah, you can't win, can you? So with your strategy, did you say you look at the DCF? Is that what you sort of focus on?
Yeah. So and amongst other things, so obviously I'll first try and understand the business. Most of the companies I invest in are businesses I've heard of or I've seen before. But very often I'll find an opportunity where I'll be like, I have no clue what this business does, don't even know what they produce. But then you start reading, what do they do? You look at their website, and this is again because most of my investments I keep them for at least 6-7 months. You understand it. I think looking at a price chart is nowhere near, because and I always say this: any investment you make, you should be able to explain it to a 10-year-old. And if you're going to go up to a 10-year-old and say, oh, the moving averages were crossing each other, even they're going to be like, what does that even mean? But if you can tell them, they produce, I don't know, they produce the cans in which Coca-Cola sells their drinks, they'll be like, oh, that's so cool, people drink so much Coke, that makes sense. So I think having that sort of fundamental basis, and I think you should always aim for 5 reasons why you're investing in a company. And yeah, valuation is one of the main things. I think at the end of the day, because stock markets are driven by this sort of auction system, right? And that you have some people bidding, some people selling, some people buying. You need to understand what the real, or for you at least, what the intrinsic value is, and based on that, decide if you want to get it or not. Because most likely, the big asset managers and big banks, which are the ones that really drive the price. I think most average investors with their 50 shares are not going to do anything to the share price. So if you're valuing it on the same principles they are, you can understand what they see in the company. I like to look at a lot of banks' equity research reports to sort of see their view on it, because obviously, there's something, even the top equity researchers, there's, equity researcher 1 might have missed something that which 2 caught on to. So yeah, DCF analysis is, probably the most basic form of analysis you can do. It's all from public information, and it gives you a very good indicator. And there's another quote that I like. I think can't remember who said it, but it's like, in the short term, the market is a voting machine, but in the long term, it's a weighing machine, and that weighing machine comes from the underlying value of the company. So, along with that, you can look at your, all sorts of valuation methods. The list is endless. If you look, take your top three, your comparable company analysis and DCF, for example, it gives you a good indication. And then if you really want to, you can go into the thing. So like when I make my valuation models, it's never on a, per share basis. It's always based on market cap or enterprise value, because, on a share price basis, that's a bit too sensitive, because those can fluctuate by way too much. Whereas the intrinsic value doesn't. So I think that's just one step. And yeah, of course, you end up going and looking at the chart at the very end, at least, because there, even if all the technicals are against it, the underlying value still says that there's value to be created, and that's why you should still buy it. Whereas traders will often miss out on that. So that's my approach, and I think so far it's been working. Of course, everyone has bad trades, and I always like to say, you don't have to be right all the time. You just have to be right more often than you're wrong. And then that obviously, that's the way to make some profit. So, and so far it's been going good.
Yeah, no, I could imagine. It looks like it, man. So, one other thing I was going to ask. So, I know it's something that you said that your friends, they were saying, why didn't you suggest that they buy more shares and force them to do that? But now, the market's quite high. It looks like it's a bit uncertain whether, will they keep going up? Will they keep going down? Do you think investors have to be a bit more savvy in the companies they choose, rather than just sort of, buying an ETF or buying shares and they'll go up automatically, like we've seen sort of last year?
I think that's the difference, right? Some people, and this again is the thing, I think some people are interested in investing. Other people just want to make money. I think those that just want to make money, you're best off with an ETF. You pay your 0.2% expense ratio. You get, you can even find some emerging market ETFs that are, annualized 20 or like 18 to 20%, which is, beats most of your developed markets. And that's like the good solution for anyone who's not really interested in it. But if you have that sort of interest and that, desire to learn more how it works, I would say, yeah, get also an ETF maybe to start with, and then try yourself with, 2 or 3 individual stocks. And then, if it goes well and you feel like you can understand it, you can slightly shift it. I would never, suggest anyone starts with just outright, putting all their money into stocks or like individual stocks, because there's a lot of risk in that, because most likely you will have missed something in your analysis, or you will have, bought it you wouldn't have done it correctly. And that's the case with most investors. I don't think any good investor has, consistently made profits. They all have to fail at some point. I think my first, trading account, which I said I will only, do short-term trades, I think I ran it into the ground in the first 2 weeks, maybe. Got too greedy, got too excited, saw all these stocks being discussed on, at the time, it was called, I think, like on Reddit, like security analysis, which they do great research, but you find all the analysis so fascinating because they put all these nice numbers in it and whatever. You buy every single one, and then you don't actually, what you should do is say, okay, hang on, does this make sense? But because the numbers, people love to see numbers, right? If I could write, this stock will go up 50%, and give you some numbers you don't understand, and you'll love it and you'll buy it. And then when it doesn't work out, what are you going to do, right? And these friends of mine particularly, they always say like, yeah, can I give you my money and can you turn it into whatever? And it's like, I can do that. But what I think is much more fun is if you keep the money and I can show you how you can do the same thing, because it's that saying, right? You can wait, what is it? Like, give a man a fish and he'll eat for a day, but if you teach him to fish, he'll eat for a while. Like, yeah, sure, you can give me your money and I'll give it, but you won't learn anything out of it. And B, there's no guarantee. No one can guarantee to, turn your money around. So I think that's what I much rather do. I'd rather, sit on a Zoom call with them, explain them some basics of fundamental or technical analysis so that they can try their hand at it. And investing is something you have to learn by doing. You can watch every Warren Buffett video. You can watch every, billionaire morning routine. It's not going to do anything unless you go and try your hand at it. And that goes to anything in life, I think, right? You can watch 50 videos on how to shoot basketballs. If you don't shoot a basketball yourself, you'll never get better at it. So I think same goes for investing. And that's the nice thing about investing. I think investing can be learned by reading. And, you read The Intelligent Investor, read One Up on Wall Street. Peter Lynch makes great books. And just read and sort of put yourself into that perspective. And then I think you'll have a much better success when you're just starting out.
Yeah, I think that's one thing I've learned. Like each year, you learn so much, and you look back at yourself, and how confident you were, and how much you thought you knew, and you're like, yeah, I've beat the market, and you're like, holy shit, yeah. Like I knew nothing.
Yeah, it's amazing, and the market is always evolving. You learn something new every single day. Yeah, it's a fascinating place to be, and I really feel, and I'm really glad that, with this rise of retail trading and even providers, because earlier, the average Joe was locked out because these big money managers had minimum deposit requirements, which is now just not completely been removed, but it's allowed a lot more people to get into it.
Yeah, awesome. Yeah, how do you think the markets will move? Because obviously, with just in general, with sort of the Reddit trader, and we've seen with GameStop, and just the availability of them being able to put capital in. Because I think we've seen just the amount of capital retail traders have in. I think it's 15% of the market or something like that,
Yeah,
which is higher than almost double than it's ever been. So, do you think that
yeah.
will have a massive impact on the volatility of the markets in certain stocks?
I think for sure. So I think let's be real here. A thing like GameStop, for example, will never happen for any large company. Retail traders don't have the money to start. If Amazon tomorrow at whatever $2,000 has 80% short interest, Reddit traders aren't going to pony up the money to squeeze the hedge funds about it. So it really depends on the type of stocks. Mostly you find them, they're in the sub $20 category. Obviously GameStop no longer isn't in that, but when the whole thing started. So it really depends what part of the market. And I remember there was one day when this whole craze was happening, and so I have a lot of news apps on my phone, and I must have gotten at least 8 notifications on a row saying this has been the most, on a volume basis, most traded days since ages, and most of it was from retail because they were all pushing their money into this, either your GameStop, AMC, whatever. So I think it's definitely a force to be reckoned with. Whether I think they'll surpass, hedge funds or something, I doubt it. This was like a one-time thing, this is like a one in a lifetime. Same with the pandemic. It's like, black swan event, as you would call it. I think the most important takeaway is not so much that they're, beating hedge funds at their own game, or, but it's that they're getting involved. I think social media is a huge place. I think hedge funds for years have been, tracking Twitter and other social media to see what sort of the buzz is, because end of the day, those are your consumers, right? Those are the people that will go to tomorrow, if there's a huge wave of people saying, oh, stop shopping at Walmart because they did something. That's social media will obviously impact that. People will stop going to Walmart, and then their sales will go down, and then the stock goes down. So I think tracking that is very interesting. And I think social media, if you look at platforms like eToro, it's great to have a social media aspect, but I would not advise anyone to. I think they have this feature called Copy Trader, which I think is the riskiest thing, because this is some random guy who could have been for 6 months made profits, and then wake up one day and just because he's angry, just make you lose all your money if you felt like it. So things like that are a bit risky, but I think exchanging each other and all these forums that you do have online, on whether it's on Discord or Reddit or even StockTwits. I'm not sure if you're familiar with StockTwits. It's like, I like Twitter for stocks basically. But just seeing stuff on there, because most of it is people that are interested in the same stock, even if it's very, very small stocks. You'll always find someone who's interested in that. You can exchange ideas, and you meet people that have the same sort of investment principles as you do, and sort of the same interest and niche. With regards to overall markets, I think I think the biggest headline was for people like value investing. I think value outperformed growth for the first time in a while, and obviously this has to do with your huge rounds of fiscal stimulus in the U.S. and COVID-19 vaccines, and I think it was since November you saw that even small caps were outperforming large caps, and your international equities were outperforming their U.S. counterparts. And I think there's just been this multi-year trend of the last 10 years probably of U.S. stocks dominating, and now you see a shift. And I think the next decade will, like I was mentioning earlier, be completely with Asia. And there was this huge headline of this rotation into value and cyclical stocks. And a lot of people now are asking, okay, is it done now? Like things are going back to normal. Should we go back into growth? And I think there's two sides to the coin. Like those who argue that it can that it has gotten to a point where it's slowing down because the COVID-19 infections are going down and whatever, are saying, okay, yeah, it is time. But then you also have to know, like in Europe, like at least here in Germany as well, the rollout of the vaccine is so slow. And that's why I think European equities, especially in value and cyclical areas, are still underpriced. Just because in the UK, I believe it's the 8th of June they want to open, but here in Germany, they're not even, it's not even on their minds on when to open it. And I think to that extent, the rotation sort of reflects where you are and what your perspective is, right? I think also if you look at the interest rates which are coming, I think interest rates are a huge overlooked factor, which I think I don't know many traders that track interest rate decisions on a regular, but most investors do. And I think there's no reason to believe, at least for the next couple of months, that you will see. There's no reason to doubt it, rather, that you'll see a further interest rate increase. So I think things like these are what really drive the markets, right? I think investors are much fun, or have a much bigger force to markets than traders do. So it's really, you have to see what they're looking at. And I think in that sense, if you really follow that and look where they're positioning their money, a lot of them are going pro risk. A lot of them are liking emerging markets. If you look at bonds, your traditional 60/40 portfolio in these times will barely get you any money, because your 40%, first of all, developed bonds are very correlated with equities. And even the emerging market bonds, which are very interesting, especially local currency bonds, which are very interesting, have a low correlation, but also they're more risky. But you're better off putting it into equities. I think anyone our age, especially, like I'm 22, I'm guessing you're around the same age. I don't know why anyone our age should have any bonds. What do you need bonds for? Even if the stock market crashes twice by the time you turn 60, it'll always recover. So I think you should be, 100% equities is very controversial. And any finance class you take about diversification, they'll all probably be getting angry at me. But for me, that's just the reality. If your goal is really to maximize your money, you have to be willing to take on the risk. And equities have outperformed bonds for, I don't know, like ages now. So I think that whole shift into younger people's investment preferences will sort of shift asset allocations more towards the more balanced thing, towards more equity preference. And then in equities, of course, you can get a I think it's Ray Dalio's all seasons portfolio that he has. You can either get one of those and just let it run its course, or what I do is, when, like, for example, now when value stocks were outperforming, I put more of my money towards value sectors. But as soon as I see that slowing down, you move it back into your technology space, especially in Asia. Like I was mentioning, technology is huge. So I think it's sort of active passive management almost. You're investing in passive products, but you're actively deciding how much to invest at any given time.
Yeah, perfect. I think what we're seeing with what the government in the US is doing, the amount of the Fed, the amount of money they're pumping into the economy, and basically what they did after that crash in March. From my personal opinion, I think that just the crashes are they're not going to be as long as 2009. That took almost probably 9 months until it sort of stops going down, and then probably 10 years until it actually recovered. Whereas you look at COVID and what happened there, a few weeks down, and then a few weeks it was back to normal, and now it's sort of gone so much higher. So do you see the same, that we'll sort of see more flash crashes and they'll just become quicker and quicker?
I think yes. I think until you see a next sort of crash the way that COVID caused it, it'll be a while. You will obviously see, could be anything, and it will be for no more than a week. I think it was also like 2 summers ago there was stock market crash because of trade tensions between the US and China, and then the week after it was up again 20-25% in emerging markets at least. So I think there's especially now with the Biden administration, which seems to be a bit more sane, if you want to put it that way.
Yeah.
I think your geopolitical risk won't be as big of a factor. So I think obviously that's the risk you can't diversify away. You have no clue what the US and China might do to each other. So that's just the risk you have to live with. But as you saw, right, and it's the same thing with my friends complaining, even if you are 100% in equities, and you won't obviously lose all your money. And I think this is the thing about systematic investing, where rather than putting 10,000 in at when you're 20, you should spread it, because then and dollar cost averaging, I know it's probably the most boring thing you can hear, because it sounds like such a passive principle, but end of the day that'll save you when you're 100% in equities and there's a crash, because not all of your whole portfolio won't get wiped out essentially. And I think going into the future, you'll definitely, there will be periods of volatility, and it's unavoidable, right? The stocks, I know everyone says stocks can only go up, but that's not the case. They over on average they go up, yes. And if you look at any chart, it's always, it goes up, and then it goes down a bit, but it always recovers. So yes, that's true. And again, that's the psychological thing, right? You have to be willing to, wake up one day and see your portfolio down 10-15%, and have that sort of strength to be like, okay, I won't sell. I'll either buy more or just hold it for another month until it recovers. So I think that's just, psychology again is a huge part in investing and trading, I think.
Yeah, and it's like I was listening to someone on Bloomberg, and they were saying how when they started their careers, I think the Dow Jones was at $100 or something. And you look at it now, like that would have been like 30-40 years ago. Now it's 30,000. So, you know,
Yeah,
just the growth. And if you think about us, we're starting our careers, you know, imagine if it had that growth in it, it would probably be faster
it's
potentially.
of course, and I think it's never too late to start investing, and I think you know, especially for young people that are in college, and you know, there's always a lot of interest. You know, like I was part of my investment society during my undergrad, and a lot of people would come up to us and they'd say, "What do you do? What do you do?" And it's like, "Yeah, we teach you how to invest. We teach you how to analyze stocks, how to pick them." And you know, it's the first meeting of the year, and there's about 250 eager first year students sitting there, and you know, I'll start my talk and I'll tell them, you know, okay, we'll start with something basic on, you know, how do you look at a company's balance sheet, you know, go through the balance sheet, look at the different items, then go to the income statement, and then you have a break, and then you, after the break, when you're like saying, okay, and now what do you do with this information, half the people have gone because they have no interest in understanding to read financial statements. They just want to know, what should we invest in. Of course that works. You can, you know, pay your whatever, you know, Instagram guru whatever, $20 a month to get signals from him, but most likely he's getting the signals from somewhere else who's doing even worse research. Or you can learn the tools. Yes, it might take you a month to learn how to read these financial statements and how to build a financial model, but from then on, it's all up to you. You can do it, you can apply it, you can use it, and you can change it. And I think that's the unfortunate thing. A lot of people get caught up in this thing of just wanting instant money or instant gratification rather than going the long way. And it might take you a month or two, but at least once you have the tools, no one can take that away from you. And then rather than having to rely on some complete stranger to give you stock recommendations, you can come up with your own. And I think it feels a hell of a lot better if you come up with your own idea and it pays off than if someone, you know, sent it to you for $20. So
Yeah, especially if you put the work in. And I think it's something that I love about trading. It's scalable. Like, so
yeah,
for us at the moment, we might not be or me, I might not be making much money, but you know, within, once I've sort of compounded, grown within 5 years, I'll probably be doing the same work, but just the amount of money you're actually making will just be that,
it
you know,
is.
that much
Yeah.
higher.
Yeah, exactly. I mean, you know, the statements don't change. Someone with a $20 account looks at it, or probably, or yeah, has the same information as someone with a $50 million account.
Yeah.
The way you analyze it doesn't change. Just your account size grows. Instead of buying 10 shares, you buy 100, you buy 1,000, you buy 100,000, and I think that's the big mistake people make. They're not willing to put in the. It's not even long hours. You do this in your free time when you know you. I'm not saying you should stop studying and do this, but yeah, it's something you have to teach yourself, and those are valuable skills for life, I think. And it's so easy, even if you don't want to invest in individual stocks, you know, rather than I keep mocking friends with this. I think there's a video. It's like, you know, billionaire morning routine has like 20 million views, and then, you know, some video about investing in index fund ETFs will have, you know, 10% of the views. And which one will realistically make you richer, right? Obviously, how to invest. You know, what time Ray Dalio wakes up does nothing for my investment portfolio. So, you know, even if I wake up at 6 a.m. and then don't do anything, what's that going to do, right? So I think that's a yeah, it's a huge probably thing hindering a lot of people from getting into it. But yeah, I really wish that people get into that more.
Yeah, I've actually saw this, like it's something where it says it's sort of about the compounding. So if you do
Yeah,
if you just do the same thing every single day, you're not going to grow. But even if you just go to the, you know, do that tiny bit, just the trajectory
yeah,
is going to
yeah.
change
I know what you mean.
massively.
Yeah,
So
yeah,
it's,
exactly. It's all about, you know, exponential growth, and these are basics. You know, like investing in at least here, I'm not sure about the regulations in the UK, but here in Germany, you want to open a brokerage account, download the app, open it. Someone calls you on like a video call. You show them your ID, and you've got your account set up. And you just literally, you go buy your MSCI World, you buy your MSCI Emerging Markets, and then you sit and wait. And that's all it takes. That's really all that you can do this in a day. Uh, it's a day's worth of work, and you're set. You set it up as a, you know, monthly investment, and that's all you need to do. And then you see which ones are doing well, which ones are not, and then you can, you know, if you're $40 in the emerging market aren't doing well, put them in technology or something else you're interested in.
yeah, perfect. So for people who are looking to sort of invest in emerging markets, are you mainly watching tech and pharmaceuticals, or are there any other industries that you're sort of watching? Or maybe just in markets in general at the moment, because it's something that,
Sure.
you know, we're seeing such a high growth. Like,
Yeah.
what are the industries you're watching?
Sure. So obviously for throughout the pandemic, you know, healthcare and tech were the huge drivers, and you know, I keep referring to this picture of, you know, what did it take for your company to have a huge technological reform, and it was, you know, spending, you know, MIT grads, you know, very small percentage, and pandemic was like the biggest bar. And I think technological spend is huge. I think there is a slowing down now because, you know, most valuations in tech are way overpriced.
Yeah.
I think you will see a consolidation. However, I think I was reading, you know, companies have amassed some more than $7.2 trillion in cash. So you will see M&A activity pick up, especially in the tech space. A lot of smaller companies, which previously might not have had that big of a need, will be the case. I think in the UK, I think 51% of people said that, or 52% of workers said that even if COVID was completely gone, they would continue working from home. You need to buy better. Instead of using your laptop at home, you want to buy a PC and whatever. So I definitely think it is the future in the long run. If you're looking at a more balanced thing, so I always hold tech at all times of the year. Even if the Nasdaq was to crash 20% tomorrow, I wouldn't divest, because I think technology is the future. And technology, the beautiful thing with technology, it's not really technology. You find technology in everything. You find it in automobiles. You find it in healthcare. You find it in your restaurants. Like you go to McDonald's, you don't have people serving anymore. You have these screens that you order from. So technology is really found in all industries, really. But outside of that, I think the healthcare sector is very interesting. And I'm not talking about things that have been emerging now. I think things like telemedicine, or like CRISPR technology, things like that. If you look at the top CRISPR companies, obviously those are subject to government approval, but I think once they're there, huge space to be in. And even obviously cyclical industries, you have to see sort of how the economy is going. But other than that, I think that's really, really a fascinating space. And within technology, if you want to break it down further, I think 3D printing, again, either for the medical sector or for industrial use. I think it could in the future be well cheaper to
Mm.
print a car part than to manufacture it from steel and whatever. And I think that brings into this entire thing of environmentally friendly production. And those are huge spaces. I think the other day I had a call with one of my friends, and we were discussing solar panels. So Hamburg, the city I live in, doesn't have a lot of sun, and here companies are literally begging you to install solar panels. They're giving you huge discounts and whatever, because no one buys them logically because the weather is just too bad for it. But I keep thinking to myself, like, okay, even if you don't use it maybe to heat your house, if you just buy it to charge your car or to light your lamps, it doesn't have to, your whole house doesn't have to run off solar energy. But I think at that point, when it's being given to you for free, it's they're not doing it because they're desperate for money. It's because they know the potential of their product, and they realize that you don't understand it, so they're willing to even sell it to you for half the price. Because then once you buy that one solar panel and you see how much it saves you on your electricity bill, the next thing you'll do is you want to fit your whole roof with solar panels, right? So I think those sort of renewable tech and renewable energy spaces are very, very fascinating. I think that brings this whole ESG thing as well. If you look at all your current private equity funds and large asset managers, there's increasing pressure from their investors to put their money into environmentally friendly things, and I think that's a great thing. I think the UN had to spend just shy of another $20 billion to meet their sustainable development goals. So I think there's a huge push, and especially with young people in Germany, at least, the Green Party, which previously had not had many, hasn't been relevant for a while, has now become huge. They're appealing to the youth. I think the smartest thing they did, at least in Germany, was the Friday before elections. So elections happen on Sunday, and on Friday they got Greta Thunberg to come to Germany and give a talk. And they, for the first, I think the election before, they had 3%. That election they got 20% of votes. So things like that, where young people are getting more interested in impact investing, if you will. And I think that's a huge space. So I think you have to really look out for that. And I think now, if you look, and this will take time, if you look now at the top ESG ETF, I think it's a European financials ETF, has the highest ESG rating. And I think there's a bit of a murky thing, like how do you really score a company's ESG characteristics, right? So I think until you have clearly defined lines, it is something for the future. I wouldn't say put all your money into that now, but people should start thinking about it for sure.
Yeah, definitely. And do you think, this is the question I had, do you think it will be the death of sort of fossil fuel shares and sort of stocks? Because I know you look at Chevron, they're going up now because of the oil price, but are a lot of these investment companies which have most of their shares, are they going to have to be forced to sort of divest away from them, do you think?
So I think I don't think they want to, because fossil fuels, end of the day, if you look at some of your countries in South America, South America, Africa, and Asia, they don't have the infrastructure and money to install wind turbines or whatever. So they will still need coal and oil and gas, etc. So I think there's no immediate sort of risk in those positions. It's more because investors, want them, or they want to know that their money is coming from a good source. So I think, unfortunately, yeah, they will have to divest. I think Chevron won't go bankrupt anytime soon. Even something oil and gas. Like your plane is not going to fly off solar energy, right? Neither is your train or your ship. Global trade, yeah, it cannot run on renewable energy, or at least not in the next 10 years, I think. So I think that'll be there, but yeah, I think it's just mounting pressure from your investors, and I think that's again where the benefit of working at a smaller shop comes in, because there you don't have this fiduciary responsibility. So yeah.
Yeah, do you think that might be why we might see more growth in sort of emerging markets as well, compared to potentially Europe? Because in Europe they're sort of being forced to cut back on a lot of these potential investments. So you look at Germany with manufacturing and sort of how important that is. They might actually be forced to sort of cut back on it because of the environmental impact.
Yeah, sure. So I think so. Maybe if you look at the environmental impact first, right? There's no doubt that preserving the environment and fighting climate change are, it is definitely a priority for everyone. And I think U.S. rejoined the Paris Climate Agreement, which is great. I think reducing carbon emissions is possible in Europe, yes, but in a place like Nigeria or Indonesia or Brazil, where you really need factories, what are you going to do? You can't go to these countries and tell them, oh, shut off your factories. We don't care how you build your schools or whatever, but you can't, your factory can't run because Europeans aren't running theirs. That's not going to work. So I think it's slightly different. I think ESG, of course, it would be great if emerging markets could apply it, but end of the day, it's not fair. The Europe and the US have polluted the world long before, have now developed themselves. So you can't now tell them that too bad for you, figure out another way to do it. So I think for it's a slightly different topic in emerging markets, but obviously it would be great to adopt it as soon as possible. Obviously the earlier the better, but at the same time you have to understand that they have their own goals. They have the exact same right to run their factories to produce whatever as you do. So I think those in the position to be those who are in a position to do it should do it. But your main goal shouldn't be shunning the ones that are dependent on it, really.
Yeah, I think that's a concern. Like, because I saw like a graph recently. I think the population growth of every continent in the past 20 years. And I think it said Africa has grown 50% like of the population just in the past 20 years. And Asia was about, almost 30% compared to Europe, which I think was 1%. So you think about, like, even though a lot of these big economies, wealthy economies, are cutting back on their what they're sort of how they're affecting the sort of the climate, a lot of these emerging countries will just continue. And I think that's sort of one of the issues that I'm seeing. But I do agree it's very important that that we do have to cut back on carbon emissions, I think. But yeah, it's like how that impacts it. Yeah, cool, man. So I was actually going to ask you about your fund now. So I know you've sort of started your own funds. Why did you decide to do that rather than potentially going, the traditional summer internship and then working for your own for an investment company?
For sure. So for me, like I said, my interest in investing started around when I was 18, 19. So because I think I've been building the skills over the last 4 or 5 years, I obviously, if I went to a big company, I could learn something. But obviously, I graduated in last year from my undergrad, which is probably the toughest job market in a while. So no one wanted to give me a job. I'll be completely not nobody, but at least not in sort of investment management, which is my passion. And I thought to myself, like I pretty much have a good skill set. I have a good track record. I can take this track record and make money for other people, or according to their rules, and sort of play their game and play by their regulations. Or I can do the same for myself and other people. And if they like my investment story and my background, fine. But I'm also perfectly happily just managing my own money, or for that, from family members or friends who, want to be part of that. So for me, it was, if two things. Like, one was, if no one's going to give me the opportunity, I'll just make my own. I don't think there is no right moment. You have to make it yourself, or you can be waiting for years. So that was sort of one thing that drove me. And the second thing was, so many of my friends from my undergrad had, graduate schemes set up, and then, 3 weeks before, they got canceled, and, they, for the past year, they've been doing nothing. So for me, it was like, people are losing everything now. The world is in a very unique place. What do I have to lose, right? I think registering a company at least overseas, is not too expensive. So you know, I you know, rang up my buddy from my undergrad, who me and him have a, you know, very strong passion for investing. And I told him, you know, I said, you know, look, me and you both have good expertise in the field. We know how to invest. We have a good track record. Why don't we, you know, make this something more professional and you know, start doing it together? Because he has great ideas. I have great ideas. I have, you know, more focused on emerging markets. He's more focused on developed markets. Both have a quantitative background. So I you know, told him, you know, what do you think of this idea? And, you know, at first he was skeptical, and he was like, yeah, why don't I, you know, go learn from one of the, you know, big companies and then do my own thing? And the thing is, and this goes for all professions, is, you know, once you see the money at a big company, you'll think to yourself, you know, if I'm making 150K a year, why bother, you know? But whereas when you're still young, like 21, 22, you haven't been corrupted by that yet, I guess. And what do you really have to lose? You know, worst comes to worst, you'll lose your whatever. I mean, if you say you start a company with 10,000 pounds, you know, losing 10,000 pounds at 22 might seem like the worst thing ever. But like I said, you have 40 years to work and recover that money. So you may as well try it, you know, because there's no guarantee. You could have also started a job and, you know, done a horrible job and get fired 2 months later. So may as well fail at something that you like doing and do it on your own terms, if at all.
Yeah, perfect. And how did you? So did you sort of register the company in the UK, and then you sort of went to your friends and family and raise money? Is that how it worked? Or I'm not sure if you
Yes.
yeah.
No, so it was actually a bit different. So for me, it was obviously first, you know, speaking with people, because there's no point, you know, setting it all up if no one trusts you. So from, and this again goes to discipline. I have every single trade I've made since 2017 in an Excel file. And you need to have that, you know, if I go up to some, you know, institution or, you know, family office and tell them, you have no clue who I am, I'm 21 years old, why don't you give me 50,000 euros? You know, they'll think you're some bum and tell you to leave. But if you show them not only your knowledge, and knowledge on markets is a different thing, but if you show them that you have that diligence and complete transparency, I don't know. I never thought I'd be able to maintain it for 5 years, and you know, it's by now I think I don't even know how many rows are in it, but I think that diligence, and when they can tell you're really interested and not just trying to, you know, get a quick buck off some, you know, unsuspecting person, rather than investing in your strategy, they're investing in your passion for it, because they can see that you've, you know, taken the effort to for 5 years log every single trade. You have a good knowledge about markets. You're willing to invest in the education that will get you there. So then at that point, they're more investing in you than not. So the registration for us actually happened way later. I think the first months, at least I spent, you know, on a weekly basis meeting with, you know, family offices, with charitable trusts, with, you know, companies, you know, in small insurance companies. So Hamburg has a lot of regional sort of insurance companies, or Germany rather. And meeting with them. The thing with the UK is it's obviously a bit different. You know, UK has so many providers out there. So for me, my focus was always to look in Germany, because here, at least like the city I'm in, we have, you know, 2 big private banks, and they have almost all the clients, and it's just public information. Their returns aren't the best. You know, most people would be better off investing in an ETF, but you know, Germany has an aging population. These are 80-year-old people. They don't have the time to find out which ETF is good. You know, they'd rather pay someone, you know, too much money to get them subpar returns. So for me, it was just, you know, going out to these people, talking to them, you know, telling them more about my drive rather than trying to sell them an investment product, because, you know, they probably get investment products pitched every day. And then fund registration happened way later, I think. So we got registered in the start of this year probably. But we only said, okay, we need to do this now after getting interest. So once you, whatever the amount is, you know, say your target is to raise 100,000 euros, you have to, even if it's not 100, even if you have 80,000 committed, then you can go and say, okay, it's worth registering it. You know, because there's no point, you know, paying whatever 10,000 for a registration if no one's going to give you their money. So it depends really how you want to do it. Of course, you can do it the other way around. But then I feel then you sort of have this pressure, because now you've registered, you've incurred a cost of 10,000 pounds. And then at that point, you will take money from anyone. These are people, like at least the investors we have are all people that are willing to say, okay, even if you lose the money, it's okay. It's a small part of their holdings. For us, it's, you know, any investment is great. You know, even if it's, you know, 5,000 pounds for all I care. So I think just knowing that they believe in you and that you have the support system. And again, it goes to learning. You know, a lot of these people, even those who ended up not investing, they said, but we like what you're doing and we're happy to have you here and teach you some stuff and whatever. So end of the day, you get something out of it. If it's not money, you get a good network, you get a contact. They might be able to refer you to someone else in the future. Or if after 2 years you're delivering good returns, they might call you back and say, we didn't believe in you 2 years ago, but we've seen that you're doing it well. We heard from so and so that you're doing well, and then it all comes. So it's a tough business for sure. Why should someone give me their money and not get an ETF? Of course. I think it's just that that personal relationship that people still value.
Yeah, perfect. So was that the biggest challenge, you think, actually getting people to commit, or were there any other challenges you found?
For sure. I mean, first of all, I think biggest challenge is convincing your parents why you want to do it, and don't want to go. I like I always say, your parents are your biggest supporters, but they're also your biggest critics, right? So, and my parents were like, "What are you doing? It's crazy. Just why can't you get a normal job like anyone else?" And I was like, "I can, but that's the thing. Like I have this passion for it. If I wasn't interested, I wouldn't do it. I wouldn't even have asked it. I would have just said, okay, go work my normal 9 to 5, or 9 to 5 it doesn't work in finance, but work my regular day job and see." But I think convincing them, or not convincing them, but rather telling them that this is what I want to do, and if it doesn't work, I can always get a job, right? That was the beauty of starting it while still at university. I could still graduate and get a normal job. So this was like sort of the prime time. And then convincing the people wasn't really the problem. I think it was just the fear. How do you pitch yourself? You walk into a room and there's 4 people sitting there with over 50 years of investment experience, and you're standing there with your 5 years of experience trying to convince them why they should give you money, or even just getting appointments. I think for the 100 emails I sent out, I must have gotten at least 3 no's for every yes, if not more. And at first it's tough, right? You feel like no one wants to listen to what you have to say. People keep telling you, not either they don't reply at all, or they tell you you're not interested, or they'll even go as far as to say that you're just too young, or like we don't believe in you, and they'll say this right back in their email. But all you really need is just one person to say, okay, even if it's just 10 minutes for coffee, sit down, tell me what you have to do, and then that's all the motivation you need. I think it comes from self-driven, and of course external motivation helps. But yeah, really, you just need one person, or one company, or one group to believe in you, and then you're set, I think.
Yeah, perfect. So you just registered in Germany at the moment, are you?
No, so the fund is actually registered in Cayman. I'm sure you can imagine why. So our fund, it's registered in London and Cayman. So we're hoping to expand across Europe. We've got great interest from Germany at the moment, but because unfortunately the UK decided to leave the EU, it makes it a bit difficult. So I think I mean a majority at the moment is from the UK, but definitely been a lot of interest, and hopefully soon we'll be able to expand. And I think right now at the moment we're 6 of us in the company, so still starting out, if you will, but really that's all you need. We're all, and this is the great thing about a investment company per se, is you don't need to spend on a huge office, because you can do everything from your home, especially now you would anyways be at home. So that's like a lot of these huge costs that you would typically have incurred, we were able to save on them or avoid them through this pandemic. And I think that's put us in a much better starting position than had we gone the traditional route of renting an overpriced office somewhere in London and going that entire route.
But so sort of just why it's different in Germany compared to other places?
Yeah, so the reason what I was saying is, like, here, if your application is rejected, I think you have to wait 3 years. But where if you've shown that getting registered in the Cayman is basically it's a walk in the park. You don't have to do much. But if you can show that because I think the financial regulatory body around the world is very well connected. In terms of all your whatever. So I think if you show that others have approved and it's been fine, and you're not doing anything dodgy or whatever, you're much more likely. So that's why we've only set up attempted to getting approved one by one, because if you get rejected by all of them in the same place, you're pretty much in every country going to get locked out. So you obviously have your obvious places like Luxembourg, Switzerland, whatever. But Germany, just because this for me is home, and we have good interest here, and I know the people here are much more likely to invest in a person than a business, whereas a lot of other people might say, oh no, we don't really care who's doing it, we just want our money to be doubled. So I think that difference just really sort of made it for sure that we definitely want to be registered here, because obviously having a local office or registration helps in a multitude of things, legal aspects, financial aspects and whatever. So, but otherwise, yeah, the process is more or less similar. I mean, I'm not too involved with that. You have your lawyers who are specialized in financial law, and they take care of that. But as long as, at the end of the month, I get a letter saying that it's been approved, I'm happy. So.
It's the most important thing, yeah. And sort of in the next 5 years, what are the plans for? Anyway, we'll say A&A Investment is what the company's called. So, what are the plans? Do you have sort of any goals that you want to achieve, or
Yeah, I
expansion?
mean, so there's two things. One's more like company side, and one's inclusion. So I went to a university where, if I think from my peers, I think, internships, maybe out of the 100 people in my class, 10 people got internships because it wasn't a target university. Very often jobs I applied for in Europe, people hadn't even heard of the university. It's only a 50-year-old university. So, it was very, very difficult. And very often I could tell it was, just because, people always say it doesn't really matter what uni you went from. But then, I remember once going to an assessment center, and there were about 20 other people there. And I was really excited. And then, they started doing what uni do you go to? What do you study? And it was like, Oxford, Cambridge, HEC Paris. And then I went up to the table. It was my turn. And I was like, these guys aren't going to know. So I was like, yeah, I study economics at the University of Kent. And half of them were just like, where is that? And the Europeans had no clue, but even the people in the UK. So for me, I know how tough it is to get a job from, if you're not at a target university. So on one aspect, we wanted, and I think a lot of smart people get locked out because of that. In the US, it's even more tough. I think there the banks recruit on campus. So if no one comes to your campus, you're stuck. So I think for me, it's one, I want to, access that world of investing to people that might, get overlooked or, not get given the opportunities. And at the second point, of course, you want to expand regions. Like I said, I find emerging markets very interesting. And I think, being there domestically gives you a much better, playing field than trying to as a foreign investor, because the foreign investors are always more tightly regulated and limited in what they can do. I'd say 5 years from now, yeah, I mean, just grow and expand. And end of the day, have fun in what you're doing more than anything. There's no point making millions and millions of euros. Not that I make millions now, but there's no point making millions of no point making millions of euros if you're not having fun what you're doing. I'd rather make a bit less but enjoy what you're doing. And I think you should approach everything in life with that.
Yeah, perfect. Well, I think that's a great place to leave it. So, Aary, thank you so much for joining us today. And
yeah, thank you so much for having me.
No problem, man. And if anyone wanted to get in contact with you or sort of look more into A&A investments, how would they do that?
Yeah, sure. I'll link you our details. And feel free to, if anyone wants to add me on LinkedIn. Yeah, I'll send you the links to all those, and then you can share it on to your listeners.
All right, perfect. Thanks again. Really appreciate it.
Thank you very much.
Thank you very much for listening, and I hope you enjoyed. If you have any suggestions of guests we should invite on the podcast, please put them down in the comments below. Otherwise, as I said, thank you so much, and please like, subscribe, and share so we continue to improve the podcast. Thank you.